Welcome back to Investing Path. Today, we're delving into the latest move by the renowned investor Michael Burry that has stirred up quite a buzz in the financial world. Burry, who's been keeping a low profile and even deleted his Twitter account earlier this year, recently released his Q213F filing, sparking intrigue among investors and media alike. At first glance, it might seem like Burry has initiated a massive bet against the stock market with two substantial put option positions on the S&P 500 and the Nasdaq 100, valued at an eye-popping $887 million and $739 million respectively. However, before we jump to conclusions, let's dig deeper into the story. Put options, the instrument Burry is using, offer a more nuanced perspective. These options grant the holder the right to sell shares at a predetermined price, the strike price. Burry's bet isn't as colossal as it's being portrayed. The reported billions represent the total market value of shares he is betting against, but the actual investment is likely much smaller due to the lower cost of put option contracts compared to stock themselves. As we unravel these intricacies of Burry's strategy, remember that the financial landscape is often more complex than meets the eye. Now, if you're ready to learn more, then stay tuned and click that like and subscribe button to continue seeing more of our content. But for now, let's get started. Now here's the catch. Burry hasn't actually wagered over $1.6 billion on these declining indices. That eye-popping number reflects the collective market value of the shares he has purchased put options against. In reality, the cost of his put option contracts is significantly lower than the actual stock price. So, let's clear things up. He hasn't staked a whopping $1.6 billion against the market. His 13F filing reveals that he acquired put options for 4 million shares, splitting 2 million each between SPY and QQQ. In total, he's procured 40,000 put option contracts, with each contract representing 100 shares. Now, let's take a peek at Yahoo Finance and observe put option contracts with expiration dates about a month from now. Depending on the strike price, we're looking at costs like 30 cents per share, $1 per share, and $6 per share. These figures are significantly lower than SPY's current share price of around $450. So, with that clarified, how much did Michael Burry truly bet against the market? Unfortunately, the reality remains shrouded in uncertainty. The reason for this uncertainty is that only the quantity of option contracts purchased and whether they were puts or calls is disclosed. Details about strike prices and expiration dates are missing. However, these factors greatly influence the cost of buying put options. The closer the strike price is to the present share price, the more the option will cost, as it's more likely to favor the buyer before expiration. Given this context, Burry's range of actions is wide. He could have placed a smaller bet anticipating a substantial market drop, or a larger one expecting a more modest fall. He could have even mixed these approaches. Furthermore, we're left in the dark about the timing of his predictions. And there's more to consider. As is often the case with Burry, his 13F disclosures are hard to interpret conclusively. He's demonstrated repeatedly that while he possesses a value investor's mindset, he is inclined to short-term trades. Unlike long-term investors like Warren Buffett or Charlie Munger, Burry frequently maneuvers in and out of the market. This rhythm is so intense that due to the 45-day holding period for 13F's post-quarter end, we can't confirm whether he still retains these put option positions. He may have already divested and turned his attention elsewhere. The same applies to alterations in his equity portfolio. With this in mind, let us shift our focus to that equity portfolio. Here's where things get intriguing. While he is gambling on the S&P 500 and Nasdaq 100's declines, he is simultaneously bolstered his portfolio with a slew of individual stocks. It's no surprise he added 25 new stocks, supplemented 3 existing holdings, trimmed 3 positions, and completely exited 15. That's a substantial overhaul. If you observe, the investment amount at quarter 2's end closely matches quarter 1's end. Essentially, he swapped numerous names while maintaining a nearly identical investment volume, giving his portfolio a distinct trader's feel. It's a point I've mentioned before and will reiterate. Compare Warren Buffett's consistent 13F history with Burry's. Notice anything? Burry's lacks cohesion, brimming with inconsistency. So, As you digest this, take it with a measure of skepticism. Now, let's address the apparent contradiction. Why would Burry buy 25 new stocks while concurrently betting on the market's descent? This perplexed me initially until a reminder from Hamish triggered an insight about the composition of the S&P 500 and Nasdaq 100. Cast your gaze on their weight side by side. Observe the top holdings in both: Apple, Microsoft, Amazon, Nvidia, Meta, Google, and Tesla. These 7 entities are now dubbed the Magnificent Seven. Why? Because they've driven a significant portion of the S&P 500's 2023 surge, fueled by fervor surrounding the buzzword artificial intelligence. Furthermore, in the case of Michael Burry's portfolio, it appears that he's strategically placing a short-term bet against the sustainability of the stock market's AI-driven hype. If these Magnificent Seven stocks, Apple, Microsoft, Amazon, Nvidia, Meta, Google, and Tesla, lose momentum given their hefty 27% combined weight in the S&P 500, they could potentially drag down the entire market, particularly the Nasdaq 100. However, in a contrasting move, Burry is also capitalizing on individual opportunities by adding 25 new stocks to his portfolio. But let's dive into his Q2 2023 portfolio activities. A major development following Q1 is Burry's decision to exit his holdings in Chinese tech stocks, notably Alibaba and JD.com. These 2 stocks, which constituted 20% of Science's US stock portfolio at Q1's end, were his top 2 largest positions, while JD would likely have resulted in a near break-even situation, given its performance. Alibaba's Q2 surge potentially yielded significant gains, possibly soaring as much as 60% higher from its Q4 low. Shifting gears, Burry's portfolio adjustment also included closing out his US regional bank positions. As regional banks face a rough spell due to depositor withdrawals, Burry seized the opportunity. Instead of targeting just 1 or 2 banks, he opted for a diversified approach, including PacWest, First Republic, Huntington Bank Shares, New York Community Bank Corp, and Western Alliance. Results from his multifaceted bet varied, with First Republic being unfavorable, Huntington Bank Shares potentially at a loss, Western Alliance at break-even, and PacWest and New York Community Bank likely in the green. Moving forward, Burry had notable additions to his portfolio. He entered the travel sector by investing in Expedia and MGM Resorts International. Expedia, with its array of travel brands, now holds a significant position in Burry's portfolio. MGM Resorts International, a global gaming and entertainment powerhouse, was another intriguing buy. Additionally, Burry allocated funds to Charter Communications, Generac Holdings, and CVS Health, an observation from Unrivaled Investing's recent video pointing out that many of these acquisitions boast low price to free cash flow multiples, aligning with Burry's classic value-oriented approach. As we explore the fascinating world of Michael Burry's investment strategies, what do you think about his dual approach of short-term maneuvers and value-oriented principles? Do you believe his calculated bets align with the ever-changing market landscape? Share your thoughts in the comments below. And remember, if you're enjoying these insights, make sure to show your appreciation by liking and subscribing to Investing Path. Your support fuels our journey through the intricate world of finance. Stay curious, stay informed, and happy investing!